Um, and basically, yeah, like I was initially saying, we'll look at a few things, issues to do with insurance, risk and insurance, regulation, and also the principles and also the issues that are pertinent. So probably this discussion will take us close to about maybe say plus or minus 30 or 40 minutes. Feel free to take some notes. I will share the best of what I know. For those that are just joining us, my name is Ronald Batanda, facilitator with the Insurance Training College. Who we appreciate this opportunity, giving us a platform on which we're able to share our views and our experience. And like we already said, always say amongst ourselves, no one knows it all. So if there are any divergent views, please feel free to note them down. At the end of the day, it's being able to complement each other with the most updated knowledge. Like we usually say, and I joke around and say with a few friends of mine, that even if you went to a court of law, lawyers will have on the same probably on the same legal document, they'll interpret it differently. Yeah? So that is how I also want to look at insurance. So what we try to do is to maintain what we call the key issues that will not change, but however, they could be divergent views on what is happening. But at the end of the day, we try to keep to the gospel truth, and feel free to think outside or remove the box as we discuss it. So first and foremost is I think the key issue we want to ask ourselves is what insurance, what is it really? What comes to the layman's mind when we talk about insurance? Here we're looking at purely issues relating to the transfer of a potential loss, and of course the issues when you're transferring a loss, the issues who are you then transferring it to? You must be transferring it to another entity. So what is critical at the end of the day is that when we look at insurance, we look at it from basically more of a process that would rotate around one person who technically we refer to as the potential client or the insured, and then we have in between there we may have an intermediary, which we'll discuss later on, and then we also then look at the insurer, the actual bearer of the risk. So basically it's one person that sees the potential of a loss, transferring it to another entity that is called the insurance company. So basically, in this transfer, for it to be legally binding, and we'll talk about how a contract basically is put into perspective. We know that at the end of the day, for a contract to be valid, there must be some form of consideration, and it's important you understand why that at the end of the day, insurance companies need to receive premium, and not only just receive premium, but receive premium in time. Because at the end of the day, what we eventually transfer is that you're transferring a risk that has the potential to occur a minute, 2 minutes away, and the insurance company must have funds available to be able to pay for such potential losses. So I think here the key takeaways at the end of the day is that it's an ecosystem where from the client through to the intermediary and then through to the insurance company, there must be a coherence of understanding that at the end of the day, while one entity or while one person is worried about transferring risk between themselves to another entity, which is the insurance company, there's also a consideration for premium. And it's this premium basically that is important. So premium plays a crucial role in what we call sealing the deal. So it is quite important at the end of the day that we understand that for insurance to work effectively, and where it has actually worked effectively in the most advanced economies, premium preferably should be paid at the onset of insurance, because ideally when I give you my risk, then automatically as an insurance company, I basically have to bear any loss that occurs thereafter. So it would only be fair that the premium is also received at the beginning or at the onset of insurance. And these are things that we need to embrace, because at the end of the day, this is where the world is moving to, where we talk about issues to do with cash and carry, and we'll discuss issues to do with regulation. So I think I've tried to basically share a few views on that. You'll allow me move to another slide. Then, of course, once premium has been transferred for this potential loss, what you're asking yourself at the end of the day, and this really comes in from a client perspective, is that the person who has paid premium in turn receives what we call a contract. And this contract basically is what we call an insurance policy. Yeah? So it's quite pertinent that if at all you have engaged an insurance company, whether it's for general insurance that relates to property, or whether it's for life insurance that is quite very popular, it's important you get what we call an insurance policy document, because it details for you the terms and conditions that basically govern how your compensation will be made. Because I mean, imagine you're taking out a loan with a bank. My assumption is that you sign a loan agreement. I don't know if anyone has been able to take a loan without necessarily signing a loan agreement. So it's the same way for insurance. But what's very important for insurance is because insurance policies are designed in such a way that the triggers for payment, which we're going to discuss, refer to as the perils. The things that insurers will pay for are usually documented, and the only way you can know that an insurance company will be able to pay you is by being able to look at what we call the insurance policy. So it's paramount that you appreciate and understand that even after premium has been paid and you receive an insurance policy, the insurance policy basically is the contract between what we call now the insured and the insurance company. Now, it is this contract that basically will govern how the different responsibilities of both parties, and at a later stage, we talk about where we require some responsibilities to be done by the insured and also responsibilities done by the insurance company. For argument's sake, you probably say the insurance policy may probably say that the insured will keep the vehicle, if you have a vehicle, or if you happen to have or hire one, that probably you'll keep it in a good mechanical condition. Only prudent to keep a vehicle in good mechanical condition, not only to save your life, but also it's only prudent that that for insurance purposes, whatever you bring to insurance is in good standard. And equally true, that same policy will say that if an event, say like fire occurs, and probably that vehicle happens to be damaged by fire, we will pay your number, and they specify it. So it is important to understand that if an insurance company is going to pay your claim or reject your claim, the only document they will have to refer to legally is going to be the insurance policy. So it's important that you understand the need to have this document always kept within near reach and always accessible, so that you can understand why and where insurance will apply or not apply. And of course, like all contracts, it's legally binding. It could be used in the courts of law. So it's not a document to be taken lightly. Yeah. So that is quite very important for us to look at. And then, well, we'll move into risk. I've always asked myself, is risk bad? Is risk good? But generally, from an insurance point of view, we know that risk basically involves uncertainty. We happen to be in very uncertain times, and for those that and I do encourage most of our members, for those that have finished the fundamentals, general insurance, life, you're finished COP, please, whenever the opportunity arises, please also enroll for the diploma, where some of these things are discussed quite at a very deep level so that you can get a feel of it. So basically, risk involves uncertainty, but also in uncertainty, there could be opportunities, there could be very potential threats. And of course, that is where basically we come from. And of course, this uncertainty is not necessarily positive, it's negative. It's not to say that insurance per se is not positive oriented in terms of mindset. It's just to say that the core purpose of insurance, the purpose of this vehicle, what I would call this, if I call it a vehicle literally, is that when people come to an insurance company, they're answering about something. So that potential usually is that they could go through a potential loss, but because they cannot be able to predict the times and the possibility and the magnitude and or frequency of what these losses would be, then automatically then that's how insurance basically comes to play. So risk on its own is a topic that we handle quite separately, and I'll deal on that later. The other critical term we have is that is called a peril. A peril basically is quite crucial because a peril basically defines those specific items that an insurance company may pay or may not pay. Basically, they are the cause of loss, but that would not be my key focus. My key focus basically is saying that for an insurance contract to trigger a claim payment or to reject even a claim, the cause of loss, which is a peril, must have been defined. And these are things that we take for granted, but I can tell you to a great level of understanding is that defining a peril is very important, because if it's not defined well, it could make the insurance contract ambiguous. And of course, as we say, if you draft a contract, you draft it against yourself, the contra profetum rule. So at the end of the day, it's important that you're able to mix a number of these terminologies and understand not from a definition point of view, but how they actually go ahead to affect how an insurance policy works or contract works. The other is to do with a hazard. A hazard, of course, is something that will increase the chance of loss. If for instance, well, typically you'll find probably most insurance policies will say that we will not insure rally cars. I mean, the key question that you're asking yourself then is that if you're not insuring rally cars, what is wrong with a rally car compared to a car that someone uses from home to work? Of course, here it's just an issue of rally cars probably move at a much higher speed. There's greater risk taking. So basically, the ordinary risk of someone who drives from home to work and vice versa probably has less risk compared to probably a rally driver that probably has about 5 or 10 races a year. So it's when hazards generally are higher, insurers will automatically price for them, and you should understand that when an insurer is not comfortable with a risk you brought on board, first of all, they have analyzed your peril, but they go ahead to try to understand also the hazard. And if the potential of that hazard to occur is quite likely or quite often, then quite likely then you will have to pay an additional premium, or potentially they may decline to actually take on the policy. And then, of course, two important terms they are used, which look similar but are very different, is the loss and the claim. And I want to just share with you just two things from my experience. One is that a loss basically involves loss of value or something losing value. A claim is a formal request to an insurance company. What is important for you to understand is that most insurance policies will technically always pay your claims when you make a formal request. for payment based on what you are claiming for if the peril occurs. But if you don't notify the insurance companies in time about the potential of a loss that has actually happened, and your claim may be declined, because naturally insurers put in time caps which require that clients or entities that have incurred the loss need to be able to notify the insurance company, preferably immediately, so that they can understand how this loss occurred, what was the cause, you understand. But I think from a practical point of view, not most clients may understand this, because I have been in scenarios where a client thinks a loss has happened, or maybe certain equipment has broken down, but probably they are trying to look for a spare, and then over the duration of time, you discover that a loss is not notified on time. And we have had 1 or 2 incidences where a claim can be declined on that basis. So it's important that we try to understand that not all losses necessarily are payable by the insurance company. I think that is something you need to pick because of a number of factors. But I think most importantly, what will probably make a loss payable is that the peril that was covered for the purposes of insurance must have occurred. I think that is what you need to basically pick from this slide. So for insurance basically to allow for a claim to be payable, it's important that we appreciate that the peril that caused the loss was part of the contract, and the contract say if this peril occurs, a peril being the cause of loss, such as fire, such as a flood, it could be injury to a third party. If that is specified in the insurance contract, then automatically that claim should be payable. It may not necessarily be payable for its full amount. There are a number of caveats in there, but at the end of the day, at least that is something that we need to pick. So notification of a loss is very important generally, and also making sure that you understand at what point a claim may be rejected or paid is really going to be based on the insurance contract that you actually have with the insurance company. Of course, we've discussed premium. Premium is basically the money that is paid for in exchange for an insurance company taking on your risk. And of course, premium preferably should be paid up front, and it's important that we understand why premium needs to be paid up front, because at the end of the day, if you bring a risk that if you bought a motor vehicle today valued at 40 million, and the next day, God forbid, it's involved in an accident and it's a total write-off, or it is actually stolen, on day 2, you'll actually be claiming 40 million shillings from the insurance company. I think it's only fair at the end of the day, then premium is paid well in advance. Of course, that is the preferred way, but at the end of the day, there are other business considerations that may be done. But the gist of it is that premium should always be paid well in advance before an insurance policy kicks off. We've talked about issues of policy, which is the legal document that details the terms of insurance. And I think the biggest challenge, I think, is most of our clients will not take time to probably read these documents word to word. But we as insurance practitioners, we as people who have appreciated insurance at this level, should take time to be able to summarize or narrate or be able to pick out critical items. At the end of the day, the way policy document is designed, we know that you should be able to tell your client, these are the key parts you can look at. You may not look out for word, but then at the end of the day, you need to be able to isolate specific items related to the insurance contract that are relevant to your client. And then, of course, assignment usually applies to life policies, of course, where you transfer policy from one person to another. That's on the life side. I think we have a life class tomorrow. And then, of course, the other issue is that of material facts, which are these are facts basically that we say need to be shared, preferably with with the insurance company in goodness. In other words, if you know there's a potential that that there's information that may influence an insurance company to take on your risk or to reject it, it's important to share this information. Though there are parameters on which guide on what information is relevant or not relevant, I think what's important at the end of the day is that share information that is relevant to your risk to the best of your knowledge. I can't say there is a stop to an end of material facts. I think there would be different judgments, biases to it. But at the end of the day, if you think that you're probably going to use your vehicle for commercial purposes, you cannot go then to an insurance company and then say, you know what, I'm going to have this vehicle, but I'm going to use it for private purposes. Because basically what that means is that you're trying to get a lower premium rating for private vehicles which have less risk, and yet your vehicle is going to do commercial work. So it's important that these facts are brought out well in advance. And it's only fair that if you bring, we talk about insurance being a pool where we put in all kinds of risk. Why would one person pay less for higher? Why would one person pay less premium for higher risk in that same pool? So it's on these same principles that we need to understand that we need to share the actual information that is needed, and these material facts are quite important. Now we'll. I hope we all. I can see for our joining. I think we have close to about 60 participants, and you're all welcome. I hope no one is dozing off, and I hope I'm adding value. We will have a session where we'll have a few questions. I have a few more slides to go. I hope I'm adding value, and I'm quite audible. I'm not speaking too fast. I guess I'll get feedback from the rest of the team. Now, there's two aspects that I want to bring out as we proceed on issues to do with risk and insurance. We need to understand that risk and insurance operate in an environment that is quite similar, in the sense that at the end of the day, the uncertainty that arises from a risk not occurring being transferred to an entity is one way you're managing risk. So basically, risk and insurance have an interrelationship, that one way of managing risk, which is a whole list of what you're seeing there, uncertainty of loss, etc. Insurance provides one platform of how to manage risk. So one critical thing that we try to share is, at the end of the day, is that we need to appreciate that there could be other ways of managing risk. Insurance should not be your first point of your first thought when you see that there is a loss. The first thing you do is go in and buy insurance. You need to understand that some risks, by their nature, either one, insurance may decline, or two, they could be managed better using other risk management methodologies. And that is why, as a risk entrepreneur, as an insurance person, you need to be of a quick value at your client to help them understand that not all risks per se necessarily are basically insurable. And we talk about various aspects to do with pure and speculative risks, which is purely what I would call important information, but also textbook. Of course, pure risks basically involve risks where the outcome is either loss or no loss, or it's basically break even, nothing happens, which is the preference of where we ideally insurance basically lies. What we basically don't cover are speculative risks where you could actually gain out of insurance. And that's why typically gambling would not be, the process of gambling would not be something you'd put at an underwriter's table for them to insure that. So that is important for us to actually appreciate. So basically, in a nutshell, what we need to understand from a risk point of view, for risks to be insurable, they must, very importantly, produce a definite loss that very importantly that is not per se under the control of the insured. We call it fortuitous in other terminologies. It is important that the insured has no control. Otherwise, then we'll go into the issues of hazards, in what we refer to as the moral hazard. That will be discussed later on. But also, we look at preferably a large number, because the beauty about the law of large numbers is that the bigger the number, or the number of subjects you have, even from a mathematical point of view, the closer you move towards the mean. In other words, you're able to easily predict an outcome with a big number of exposures. So it's quite easy to probably insure 1 million vehicles, because you're able to work out through statistics and a number of other mathematical modules the possibility of one vehicle totally being damaged. However, it would be quite very probably difficult to say that I'm only going to insure probably say maybe say 5 phones. The sample space is so limited for you to understand what premium would I be charging. And it takes us back at the end of the day to understanding that in this pool where we all put our risks, premium is basically determined based on what we call risk profiles. And of course, that's for us to discuss at a later stage. However, also for risks, the loss must be quantifiable. And I think it's obvious if your vehicle has been damaged. I use the simplest of examples, purely vehicles, for ease of reference. Usually, insurance companies will ask you for argument's sake, maybe you get us repair invoices. So at the end of the day, you can quantify a loss. You understand that? And it's important to quantify a loss, because that will be the basis upon which an insurance company will make a payment. And then, of course, we talk about perils. Perils should not necessarily affect a whole number of insured simultaneously. That's a point of contention. But at the end of the day, for the people who do what we call risk modeling, there's a possibility that you could have an accumulation. And an accumulation basically refers to the potential that a risk could spill over. You could have a flood affecting 50 houses and not just one house. So with the possibility of accumulations, insurers then are able to plug in what we would call probably the correct pricing. And then, of course, it must cause financial loss, which basically we have discussed among all this. So the key takeaway that we need to pick from risk is that not necessarily all risks are insurable. And I think that's very important for you to help you to generally perceive and understand, and that you should always have alternative ways on how to manage risk. Insurance is just one way, because insurance is a risk transfer mechanism. There are also other risk transfer mechanisms outside insurance that we will talk about. So just look at insurance as one of those ways in which risk can be managed. And I will probably share a little bit in detail how to manage risk. So very importantly, one of the quick ways of managing risk, we talk about, someone gave it the acronym, I picked it up recently, RAT, which is RR80, and basically stands for you either retain, you either reduce, you avoid, and transfer, RAT, with the double R in terms of managing risk. For those that want for quick memory purposes, it's RAT basically. Double R with then an A and a T. So you either retain, you either reduce, you either avoid or transfer. In terms of avoidance, basically, it's a logical decision. I will not take anything, I won't take any risk. The practicability of avoiding risk is it is possible, but it's feasibly very hard. I mean, we're even in these unprecedented times where they say probably stay at home. Well, some are not actually staying at home. So risk avoidance, while we know that is purely a very good strategy, the practicability about it has its own challenges. So it's one of those, I call it my last choices personally for me in terms of risk avoidance. Issues to do with retention relate to where organizations opt to retain risk. Partly, it could be that they have done it consciously in the sense that they have the resources and the money to actually retain risk, or they could do it unconsciously, which would also be disastrous in the sense that if something happens, they're bound to bear that loss. So retaining a risk, for instance, in the simplest of terms, would probably say you've maybe you say that I'll set up, if you probably have a client that is in manufacturing, if they set up a clinic on their premises, oh, even that's too far. We all went through secondary schools. We used to have clinics at school. The first point of reference was if you're not feeling well, you go to the sick bay. So technically, it's a form of risk retention in the sense that you don't necessarily have to be driven to a hospital. So risk retention basically says is a way of accommodating risk without per se transferring it. You only transfer at the point probably where you think of to another example. Then of course, transferring of risk is at the point where you think risk is quite large or huge, then you pass it over. And probably that is where we talk about issues to do with insurance. And insurance basically is a risk transfer mechanism. So remember that we have an option to avoid risk, which we discussed. We could choose to retain risk, but if you're retaining risk, the number of parameters, then there's a thought process that you need to go through with risk retention. With risk transfer, you can do it through insurance, you could do it through legal contracts, you could find all types of mechanisms. You could set up a captive. There are ways that you can transfer risk that are quite numerous. Insurance only just provides one of them, and that's the beauty about it. So I would want us to look at insurance and risk from a point of view that there are other numerous ways of being able to transfer risk. And of course, what we always advocate for, and very importantly, is risk reduction. And I think this is where we think our clients necessarily should take a lot of time, because not all risks will be accepted by insurance companies. And the key question would be then, if not all risks are insurable, then what options do your clients have? They could transfer, that could work. They could try to avoid, which is very difficult. They could try to retain, they may not have the finances. But if a client over time invests in what we call risk reduction, where you take time to implement measures that basically reduce on the potential of loss, both from a frequency point of view and also from a severity point of view. Then at the end of the day, these measures basically help the client work efficiently. When a client invests, say maybe in fire extinguishers, what would you have fire extinguishers in your premises? It is, well, it could be for compliance, which would be very sad. But what is important is that you want to minimize the spread of fire. Would you want your records, would you want your equipment to be damaged by fire that would probably put down your business for probably say a month or 2 months or 3 months, or would you rather have fire extinguishers reduce the possibility of the spread of fire. Of course, that includes issues to do with training the various people who are going to probably be able to use them. So I'm a strong advocate for risk reduction in terms of being a key way of managing risk. I appreciate all the rest, but we really believe in risk reduction as being very critical, because with risk reduction, there's what we call you develop a sustainable business model, because then risk becomes part of your daily language, your daily thought process. So risk reduction, personally for me, is something that we invest a lot in, and it's something that you need to take a lot of. And then I think I'm getting a bit of feedback. I think there's someone who has not muted. Okay, all online. It's just a quarter past 11. I think we're still doing well. We have about 15 or so more minutes before probably we take a bit on questions. And I guess the IT team is probably gathering up a few questions that you may have. Please, if you have any questions, feel free to share. I'm sure there's a coordinator on the other side that is supporting me as well. This slide basically talks about our RAT concept, where you reduce, retain is under acceptancy, and then you avoid and share. So basically, of course, when you have when the potential of loss is high, when the potential of, we'll start with my first right. You'll share risk where you expect high damage, but there's a low frequency, yeah? And the issue is that you probably don't have the finances. When we go to the upper quadrant of avoiding, if you have risks that are of high damage and high frequency, you typically need to what? Avoid them. But the key question is, maybe that I would want to pose is, what risks do we have that fall in quadrant of avoiding that are both high in frequency and high on damage? I usually put that as it is and ask ourselves. Even now, you could ask yourself, think through it. What risks have you encountered that typically are of high frequency and high damage? If we looked at, if we try to look at maybe say, I mean, high damage, maybe let's say, and God forbid, an aeroplane probably maybe collides or something, then the key issue there is that, yes, there is high damage, but how many plane crashes do you have? On the contrary, you probably have more vehicles having accidents, but the key issue is that probably the damage is less. So risks that fall in the quadrant of high frequency and high damage are quite very interesting, and always I would want members to share at the end of it how we can be able to share some of those. Then the other is to do with reduction. If you have risks that of high frequency and low damage, and then those are risks that typically you're able to work on reduction. It could be having personal protective equipment for your employees, who, if you work in the manufacturing industry, it could be meaning installing an anti-theft device for your vehicle. You're reducing the possibility of theft. So basically, risk reduction is something that is done, what I would call it's done proactively, and it is something that is easily adaptable. Then also, of course, risks that you choose to retain or stroke accept are risks that are of very low frequency and very low damage. And of course, the key issue here is that in you accepting these risks, you have done an analysis. Retention should be done consciously, and should also have, there should be mindset to it. If you're retaining risk, it's not something that you just all of a sudden just choose to do, and you probably just you just I mean, have it any way you'd wish to do so. I shared my screen. I can see a few writings. Please, I would request whoever is the back end. I can see someone drawing lines. I hope you can all hear me. I shared my screen, but please be nice. I can see someone drawing some few lines, and clearly it's not me. Well, that takes us to risk and insurance. Um, I thought this slide is very important, though it's for 2018. But one thing we all need to appreciate in insurance is that we talked about issues to do with terminologies. What we need to understand and appreciate is that for you to say you have worked in insurance requires you to appreciate what we call the not only the terminology but the trends. And trends here, we're interested in you being able to understand what is actually happening in terms of how the industry is performing. For instance, how many insurers? I mean, you would want to have a conversation with your client or with your peers, in the sense that you know how many insurance companies are operating in your industry. You know how many probably health management organizations you have. All those are key players in the industry. You'd want to know what kind of premium, what we call gross written premium, is being written, and by which section. We have general insurance and we'll have life insurance. For instance, from 2018 statistics, allow me to resay this. This was picked from the IR report for 2018. The 2019 report is not yet out, but you can see there's an increase in what we call gross written premium, and these are terms that we need to appreciate. We don't per se use, okay, we could call it revenue, but basically it's gross written premium, which basically is saying all the premium we write as an industry. So they say it's in the previous year was 507 billion. It has gone 569. So there's an increment of 12%. Why statistics are very important, maybe just to bring those that to appreciate it, is that they help you understand if an industry is growing. For instance, if non-business, which is general insurance, is growing by 12%, then generally you'd be asking yourself, should this growth be 12%? Should it be 15%? Should it be 20%? Even for your personal goals and ambitions, I would be probably expecting that if the industry is growing probably at 12%, maybe as your target, maybe for next year, I'll probably say, you know what, you can also grow by probably about 20% over and above the industry average. Any investor would want to understand how an industry is growing, because growth basically gives confidence that at the end of the day, if you invest money, your money is able to grow. And that is why at the end of the day, while we could be looked at as the very many insurance salespeople here and there, it's to increase penetration in the awareness. A lot is being done in that area. But the industry has to grow in a way that attracts investors, attracts innovations. And then, of course, you already see life generally grows much faster. And of course, I think we will share ideas on why life is growing faster. But it grew by 28% from 2017 to 2018. But at the end of the day, these are things that we need to basically understand, because these parameters basically speak into how the industry is performing. But of course, of very important interest is health management organizations, which had a very huge jump, and this basically refers to hospitals basically that basically sell insurance. At the end of it all, we'll probably discuss the different players shortly in the insurance industry, and we'll pick up, also be able to talk about what we call as gross claims paid. In short, it's important that you also know claims being paid in the industry are nice, because at the end of the day, we exist to pay claims. I hope you all agree with me. From an insurance point of view, we exist to actually pay claims. And if claims are increasing, I wouldn't want to say it's a bad thing. It has two connotations to it. It means claims are being paid, and of course these must be valid claims. But most importantly, it's also a sign that insurers basically are living up to the obligations. The only challenge probably to this would be that what portion of these claims are valid and invalid, and of course a lot has been done about how to manage fraud in terms of claims, from my personal point of view, at the end of the day, we have now the anti-fraud desk that sits at the IRA. Of course, the issue is that insurance companies want to pay valid claims, but the challenge will always be that there will be people out there who probably want to either inflate claims or submit fictitious claims, etc., etc. So it is important that we appreciate that while insurance companies have the will, have invested in resources to be able to pay claims, we sensitize our clients that claims need to be valid, because if claims paid are significantly very high, what happens is that insurance companies basically increase the price of insurance. And world over, that's how it operates. Generally, two things. If you have claims for one class significantly going up, automatically it means that that class is not profitable, or the potential probably is that there could be possibility that there's a lot of fraud for that particular class of insurance. And what insurers actually do is basically increase the premium. But then at the end of the day, this affects the final client. And if clients can't afford premium, then we will have significant challenges. So at the end of the day, I think it's how you look at gross claims paid, the number of angles you can be able to pick up on that. And then generally, of course, the industry grew by 17%, which was a good, that was 2017 to 2018. The statistics for 2019, I think, will be partially ready, but I couldn't share till they actually confirmed by the regulator, which is the right way to do it, since they're the final authors of the documents. Very quickly, I think this is a quick narrative of what we've been discussing in terms of numbers. I will not go through the detail to save on time. But probably it's just to look at, this slide is quite important, I think, in my opinion, in terms of trying to appreciate what we call licensed players. We'll agree that for you to be able to be in the insurance industry, you need to be licensed, and you need to be licensed by the Insurance Regulatory Authority. So basically, you could see we have had basically one reinsurer, which is Uganda Re. Basically, reinsurers exist to insure insurance companies. You have non-life insurers. The number seems to be quite constant. I think 2017 increasing by only about 2 companies. That was as of 2018. You have life insurance companies that have pretty much remained constant. You have HMOs that incrementally were very many, and some of them, of course, stopped writing insurance. And if you try to look at the genesis of why some of these players, specifically HMOs, from what I pick when you discuss with your colleagues, some of them were not able to sustainably pay claims over time, even if receiving premium. So what happens in the insurance industry is that you need to understand that there's what we call a soft and hard market. A soft market basically means you have a higher supply for insurance. The demand is there, so basically premiums are low. But the market will harden when there are fewer suppliers of insurance. So if you have fewer life insurers, fewer non-life insurers, fewer HMOs, but there's a high demand for insurance, automatically the premiums go up, and we call that a hard market. So basically, this alone basically can help you. We have micro. we have reinsurance brokers. We have loss assessors. They're quite, the number is quite, which is a good thing. And then, of course, bank assurance agents. We all know that right now that we're allowed to, banks are allowed to basically transact as intermediaries. So we will see the impact of how this eventually do. We just a moment. Just a moment. I'm just sharing the screen again from where I were. Just a moment. We'll go back to the slide we were at. I hope you're all there. If you have any questions, please feel free to take them down. Well, this specific slide looks at here basically looks at key regulations that have taken place, and I hope you're all aware that we have the Insurance Act that was due later on. Of course, we know we have the yellow card scheme. Yellow card basically allows you to move, allows you buy insurance in such a way that you're able to move from one country to another. And we have the yellow card scheme. You have the Workers' Compensation Act that specifies that basically if you have workers, you need to buy insurance for them. And then, of course, we have a number of associations, and of course, most importantly, we have our regulator, who is quite paramount in the way we run the industry, and I'll share a few details on that. At this point, I would want us to take a small break, probably just a 5-minute break, just to ponder on a few things that I've discussed, and also for you to be able to share your questions. I'll request my other coordinator, Ronnie. Ronnie, do you have any questions that you're able to get for me? Or have you been able to get some questions? Or Anna?
I think Anna has been getting some on the chat, but let us get a few of them, then I can share with you.
Thank you very much. Thank you very much. Yeah, that's the teamwork in the background. I do appreciate. Please share any questions you have. Very quickly, as I come to a close, I just thought this slide is very important for us to understand the market we operate in. We operate in a market basically that we have insurance companies, we have reinsurance companies, we have what we call a captive, we have intermediaries, we have service providers. All these have a critical role they basically play. Insurance companies basically are the providers for insurance. In other words, they basically sell insurance. You understand? And the argument is that they're able to sell insurance to an intermediary and then over to probably say clients. You understand? So the insurance market basically will have a number of players, and all operate within what I call an ecosystem, in the sense that they are in one way interrelated to the other. And I'll just give you a very quick narrative to this. If you look at an insurance company, for an insurance company to operate, the regulation requires that it has reinsurance support. In other words, it has both reinsurance support to cover part or portion of the risks it's going to take over. So basically, an insurance company will then automatically come to a reinsurance company for support. You understand? And then, for an insurance company to be able to sell its products, it has to work with intermediaries. Intermediaries could be agents, they could be brokers, it could be the bank, it could be anyone licensed to sell insurance. Because to sell insurance, you must be licensed as an intermediary. You understand? Now, for the insurance company to be able to make sales, they need an intermediary who's going to look for the final client. But in this whole ecosystem, at the end of the day, we also have other service provider, what I would call other people who support the system. In there, we have people that we have loss adjusters who basically, will work with the claims department for the insurance company. We have loss assessors, we have the police, we have doctors. In other words, the ecosystem is so large that at some point someone is contributing. And probably what then this probably speaks to me is that there are opportunities. When you look at insurance, some people always ask me, can you refer me to an insurance company? And I tell them that we have a very huge ecosystem that is hugely untapped in terms of expertise, in terms of we don't have 100% skills available for this whole ecosystem, how the insurance market operates. If it comes to service providers, there's a skills gap, which automatically, of course, we cater for from maybe say from a training aspect as the training college. But I'm just saying some companies don't have enough of those skill set to be able to carry out their functions. So at the end of the day, the ecosystem is so large that there's a lot for everyone to share. What we probably need to ask ourselves is, where do I want to specialize in? Do I want to be a risk surveyor? Do I want to be a loss adjuster? What courses are available through probably the training college? You understand? What do I need to learn to work in a reinsurance company? Where do I start from? But the opportunities are quite large, and it's for us to harness them and be able to make this insurance market playing field be even. Of course, we have captives. Captives basically are set up by companies to insure their own risks. Those form a small component, but I'll not go into much detail. Issues to do with regulation of insurance are very, very important. And I'm just going to, you'll allow me to go through these slides quite quickly, just for you to bring you up to speed. I've been asked about, very importantly, people always think the IRA sits and enjoys its regulating, but there's a lot of work the IRA does that makes sure this industry is basically running efficiently and effectively. The IRA, in my opinion, amongst these roles that you'll probably be able to see, I think what is very important for us to understand is that while the IRA exists to regulate the insurance, the various insurance market players effectively in a way that they do not jeopardize the policyholders, the mindset basically at the end of the day is that the key role of the IRA is that they're focused on regulating the industry in a way that basically protects policyholders. And that is important for us to understand. At the end of the day, the rights of our clients are very critical, because it's our clients that will basically portray what kind of insurance we're basically offering. So if there's no one to protect the policyholders, then insurers may choose to do as they wish, for lack of a better word. And that's why the IRA exists. It's just to to keep in line. And the IRA is not a policeman in any case. They're there to support. They're there to give guidance, and they are the strategic partner for all insurance companies. They help in the sense that they're there to give us guidance where there's no common goal. They come in to be able to create a common goal. But all this is basically to protect the policy holders, and that is very, very important for us to understand, among the all other roles that they actually do. So of course, there have been recent developments in insurance that were, and of course, quite a number of those that some of you have experienced. We have the cash and carry that basically dictates if you basically take insurance, you pay cash for it, and which is quite, of course, it is new, but there's nothing. I mean, like I earlier said, if you're giving me risk today, it would only be fair you pay me the premium then, because I'm still liable for the full value of the loss as and when it occurs, even if it's on the same day or a day apart. I still have to carry that risk. So it's only fair that you pay the premium for it. Then the other is to do with risk-based supervision, which basically, in a nutshell, is saying if you're carrying out as an insurance company, if you're underwriting, which means you're taking some risks that are more prone to loss, you need to have enough capital to be able to underwrite those risks. So basically, risk-based supervision is something that the IRA has been gradually trying to have the insurance companies adapt. It's a process. To be honest with you, it's a process. It's not something that per se is 100% done, but it is a process. But it's a good step in the direction that, excuse me, in the sense that if insurers are able to take on risk based on the capital they have, then they'll probably be more efficient, in my opinion, in being able to specialize in the risks they actually underwrite. So maybe it's an opportunity for specialist companies to come on board because probably they know how to underwrite a particular class of insurance, and they also have the capital to pay the claims. So I think for me, there are very good pros to risk-based supervision. Implementation, yes, insurers are saying, well, there are challenges here and there, but there's no better way to start than just start it. That's the way. That's what we believe. It's as simple as put your gas on put your leg on the gas pedal and just start, and then see how far you can go, and then amend and fix it as you go on. We have control functions. Of course, control functions require you to have an auditor, require you to have a risk professional, an actuary. Control functions basically saying, in banks, when we talk about control functions, they'll probably, in the banking industry, they'll probably pick it much faster. But generally, control functions are there to make sure that the number of checks and balances along the way, not to slow down any processes. By the way, when we have a control function, you may think that these are functions that are put to slow down or to create a bit of bureaucracy or etc. The control functions exist to make sure that the way you're running your business is per the mandate, both as directed by your shareholders, your board of directors, and of course, very importantly, your regulator, very importantly. So a control function exists to make sure that those specific things you've set out to actually do, you're actually doing them accordingly. And that is why at the end of the day, it's important to have a control function so that you run your business in an effective way. And of course, we had the bank assurance regulations that allowed banks basically to be intermediaries. Of course, well, people feel undone. It's a very contentious topic. I don't even want to go in there, but I'm sure a number of questions will come through on, well, banks are doing X, Y, and Z. But at the end of the day, to be honest, banks have been selling insurance way before we started the private insurance ourselves. So it's not something new per se. But now there's a regulation. And the bit about regulation is that they have been given parameters under which they operate. But the issue is that now we probably have more players. The issue is, how do we then innovate? How do we positively disrupt the industry per se, in a way that adds value to our clients, adds value to other stakeholders? So we saw it coming. We just need to be able to appreciate it. Then of course, there's the Mandatory Vehicle Insurance Bill. We know the Motor Third Party Act, which is being amended to increase the limits. Currently, I think within the region, which means East Africa, it's just for Uganda, where you probably have just motor third party covering third party bodily injury. We don't pay for property damage, and these are some of the things that are being put in the bill for it to be actually passed. The beauty about it will cater for both what we call third party bodily injury and third party property damage, up to limits that are quite at least reasonable. Because currently, I think the limit is just $1 million shillings, so it is quite an amount that may not be able to hold in case something happened. And of course, more recently, we had I think close to the end of last year, we had the marine insurance regulations that were released that now require any imports that are coming through the country to have. You need to have boat insurance, but boat it locally. And I think for me, this is a positive for the industry, because I think one way typically we can grow insurance is by making it mandatory for some class of insurance. Otherwise, then most of these insurance premiums are basically going elsewhere, because when you're importing your vehicle, it comes with it comes with freight, probably insurance, etc. But you pay that to an insurance company that is elsewhere through various costs. So basically, what we are doing now is that if you're importing your vehicle, the insurance must be bought locally here, which is a good thing, because I think that benefits us as a whole. And I think that's something that is very, very important for us to appreciate. These slides will be shared with you. These are the details of what I've just been discussing, and you'll always get time to read through. I just wanted to conclude with approaches to how insurance is basically how the regulator regulates the industry. And I think these approaches are basically, they crisscross. Is what we call rules-based supervision. There's what we call principle-based supervision and risk-based supervision. Basically, rules-based is very simple. We set the rules, you have to follow them. That is rules-based. It's either do it or not. Have this amount of money available. That's one way you can supervise an industry. The other is principle-based, where you set a number of principles, and per se you allow a leeway for companies to be able to work within those principles. Principles basically guide. Yeah? A principle could be, it's a good practice to have X, Y, and Z. So that forms a basic principle. So the genesis